If you have some knowledge or insights into the world of investing, you're probably familiar with certain basic fundamentals. However, if you are unfamiliar with these notions, don't worry. We are here to help you. In this video, we'll go over 12 important investment principles to help you make sound decisions and keep your finances on track. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Number 1. Diversification is critical. It stands out as one of the most effective ways for saving capital while still achieving a positive return on investment. It is general knowledge that equities behave like roller coasters, with constant oscillations affected by market dynamics and the wider economic situation. As a result, it is no surprise that experienced financial professionals continually urge diversifying one's investing portfolio. Diversification means spreading your investments over multiple asset classes, such as bonds, commodities, and equities from a variety of industries, including technology, energy, and healthcare. If you don't enjoy losing money, diversity is your best friend. It helps to protect your investments while also increasing their value. Diversifying your portfolio is like protection against the ups and downs of the financial markets, which can gradually eat away at your money. For example, suppose 2 of the 5 equities in your investing portfolio underperform. In such circumstances, the strong performance of the other 3 stocks can compensate for the losses experienced by the weaker investments. This principle significantly reduces the risk associated with your whole investment portfolio. Number 2. Risk and reward are inextricably intertwined. The underlying idea that underpins all investments is that risk and return are essentially 2 sides of the same coin. In essence, the higher the risk, the greater the potential reward. For example, take an investment that returns more than 20% of your initial capital. It is considered to be riskier than an investment that promises a 10% return. Furthermore, it is critical to note that investments with rapid and significant growth are inherently high risk. For example, suppose you invested in a stock that increased by 50% in a single year, reflecting an amazing return on your investment. Remember that this stock can rise quickly, but it can also fall quickly, so understanding its volatility is critical. As we all know, safe investments provide relatively small returns on capital, yet many investors prefer these options to protect their hard-earned money. However, for risk-takers looking for significant profits, these conservative options may not be as appealing. Instead, they pursue riskier options with the potential for large returns, like as investing in startups and participating in initial public offerings. With this in mind, you ultimately decide how to navigate your financial strategy. Number 3. Investment costs are important. Every expense matters, including a little 1% fee that many people overlook. Many people forget about the minor fees they pay, which is a lapse in their financial prudence. A apparently modest 1% fee may not appear to be very significant at first glance, but when the figures are crunched, the potential loss is staggering. Consider the following scenario. You're looking for a fund manager and come across 2 attractive possibilities. One charges an annual management fee of 1.5%, while the other charges 0.5%. The disparity may not appear to be substantial at the time, but over time, that tiny fee difference could result in a loss of thousands of dollars. There is a widespread misconception that fund companies that charge greater fees have more resources for research, implying that they perform better. However, research findings contradict this view. Investors who actively reduce all of their costs likely to earn better overall results. Number 4. Regression to the mean is a thing. Some of you may find this perplexing, although it isn't terribly complex. Essentially, it comes down to the premise that everything in our world tends to return to its historical averages, whether it's the average return on investment or the annual rainfall numbers. Consider the following scenario. For the previous 3 years, a stock has continuously delivered a fantastic ROI of 28% or more per year, although the average return rate for similar equities is 9%. While every investor hopes to uncover a company that can continuously yield a 28% or higher yearly return, as shown in our example, such occurrences are uncommon. Most equities, like the one stated earlier, typically revert to their industry's average performance and historical yearly growth rate. So, despite the stock's remarkable rise of 28% or more per year over the past 3 years, it is extremely likely to revert to the industry average of 9%. When evaluating equities, investors frequently focus on the most recent results for an asset class rather than historical trends. Their goal is to anticipate and forecast future performance. Because of the concept of regression to the mean, companies that have consistently outperformed for a few years are more likely to underperform in the next years. It is practically impossible for an investment that has previously given modest returns, say over the last 15 years, to suddenly become a substantial profit producer. Number 5. Asset allocation is critical. It is critical to diversify your investments among various asset classes if you want to maximize your results. This is a significant moment at which many investors make mistakes, frequently failing to give their asset allocation strategies enough thought. Investing mainly in overvalued assets inevitably results in lower long-term returns. The fundamental method requires continually analyzing all asset categories, allocating less to pricey ones and more to those that give discounted prospects. Number 6, leave a margin of safety. The importance of pricing and value in investment is an ongoing consideration. Maintaining a margin of safety is one of the most important ideas in investing. In essence, this implies purchasing assets at a lower cost than their true value, therefore securing them at a discount. There are times when assets are valued below their intrinsic values, especially during economic downturns. Purchasing an item at a discounted or below market price provides a lucrative opportunity for investors because it almost guarantees a positive return on investment. Furthermore, if you need to sell the item immediately for any reason, the margin of safety protects your investment. We understand that financial markets can fluctuate swiftly in reaction to a variety of causes. Consider the case of the COVID-19 pandemic. Markets around the world fell precipitously in a short period of time. Number 7, the power of compounding. If you want to see significant increase, you need to spend some time learning about compounding. Dedicate time to understanding its physics and how you may use it to potentially double your profits. One of the most exciting aspects of compounding is its ability to enhance the growth of your capital over time. Instead of often extracting dividends, consider leaving your money invested to see big incremental increases. Number 8, adopt a long-term perspective. While taking chances in the financial markets can result in some profit, chasing the trend usually results in significant losses. The true core and attractiveness of trading lies in acquiring an asset at a low price and patiently waiting for its appreciation. This may take some time, but as Warren Buffett recommends, prioritizing long-term investments is one of the most important aspects of successful investing. Short-term trading often results in reduced returns or ultimately losses. Instead of allowing unbridled greed to dictate your decision-making process, let time take its course. Number 9, take control of your future. It is critical to manage your money since no one will be as concerned about your financial situation as you are. The prevalence of conflicts of interest, fraudulent activity, and expensive fees makes self-investment a very enticing option. Fortunately, technological improvements and the availability of the internet have led to a reduction in fees and other transaction costs. Furthermore, these digital resources provide all the knowledge needed to make sound investment selections. There has never been a better time to become an independent investor. Instead of focusing solely on the prospect of hiring a fund manager or financial expert, consider what you can accomplish alone. You might be pleasantly surprised by the large cost savings available in terms of fees and transaction charges. Number 10, risk management. Important things in life include some risk, and investing is no exception. To mitigate these risks, investors use risk management measures. Within the area of investing, portfolio volatility stands out as a significant concern that can quickly destroy money. This is a huge obstacle, especially during bear markets, which are marked by dropping share prices and a general propensity to sell. Effective risk management is critical to protecting your money. While portfolio volatility is manageable, market volatility is beyond an investor's control. Nonetheless, amid market instability, intriguing chances frequently emerge. Prepare to take these opportunities when the time is perfect. Be wary of inflated assets and keep the flexibility to reallocate your investments when market conditions improve. Number 11, never give up. Make a commitment to continued study and research. The internet provides a lot of information that you can use to remain up to date on emerging trends, uncover new investment opportunities, and explore various ways to use your capital. Many of these resources are free, while some may need a small fee. Keep a close eye on business news to obtain insights into current trends, and you'll eventually develop into a competent investor by your own efforts. Number 12, do not take it personally. Successes and setbacks will occur, as they do in many aspects of life. Investing, in particular, has the potential for small gains, large profits, or even entire losses. Return rates are subject to market conditions, which might work in your favor or against you. It is critical not to let failures discourage you and to remain determined to invest your funds consistently. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?